Hi, and welcome to the Macro Show. We talk macro, and let's just face it, you're probably tuning in at this time just to see if I am ready to quit and say I'm wrong and admit all those things. But no, things are really getting interesting to know the kingdom is still alive and well. When I have not told any of you, the kingdom has two walls. They breached the first one, big deal. There's two. You didn't know it, but we'll talk about the second wall today and why it's so sturdy. No one's going to get that knocked down at all. We're going to talk about the yield curve today. Is it actually predicting that rates are about to fall? We're going to talk about the SLR. Some of you have been asking me, like, okay, what's this deal with the SLR? Is it really super bad news for bonds? Actually, I don't think it's bad news at all, but I'll let you be the judge. We've got some economic data, some China deval charts to look at from our buddy Skywalker. We've got net speculative position, got all kinds of cool bond stuff because, like I said, things are really getting interesting. And they're getting interesting in a way that if you just look at price, you would be like, I can't see how you can think this is interesting at all. You're going to love it. So let's start out with talking about the yield curve and what's going on there, because a lot of people have been extremely critical and saying, look, you've totally played this wrong. You've been on the wrong side of this for eons. Even that's not actually true at all. It's all relative to when people tune into the show and form their opinion on and then assess where I'm wrong based on the chart they want to look at. But anyway, the yield curve is telling us that this might be the peak in yields. This might be it. It might be over. And if you look at this and you say, okay, how could I have been so wrong? I've literally played this by the book. If you go back 40 years and you say, okay, how should you play the market when the yield curve is doing certain things? The low risk, high return bet is in bonds. And you play that. And this is the first time where we've really seen kind of a move away from that. But don't worry, history always has a way of coming back to normal. Let's take a look at the yield curve. And so what is this? This is the 10-year treasury yield minus the 2-year treasury yield. That's in blue. And some of you will be pleased to know I turned the tooltips off on this chart. And we've got the 10-year constant maturity below that, just so you can kind of get a picture of what's going on here. And what you can see going back to the 80s is when you get a bottom in the yield curve around zero or a low point in here, that's usually where you want to start buying bonds. It doesn't mean you have to go out and buy, 30-year zeros or anything. It just means you want to start buying bonds because this trend is going to be your friend. And as the yield curve goes up, there are some moves where it backs up and then you just start adding on to your risk. This has gotten smoothed out over the years. So you can see here in where the yield curve bottom in the 90s and it started going up, well, that's where you wanted to buy bonds. And as it goes up here, you'll notice I added this green line at the one line, the one being over here, not on the right. And that's kind of where you say, okay, this game is pretty much over. The 2s are going down, the 10s are going down, the long bond, the 30 is going down, everything's going down. And so kind of as you go down this and you get more validation, you just want to add to your duration risk. That's what you would do. That's how you play this. You see it here again going into I don't have tooltips turned on. So we're looking early 2000. You get a peak in yield. You get a kind of bottom in the yield curve. As it goes up, what do? You start adding to your position. Sure, it backs up and then it crashes down. It backs up and crashes down. So you're going to add to your risk and you come out okay. In fact, you can see here when it gets to this one line, you get a little bit of a backup and then a hard move down. And you even get that going into the great financial crisis. The yield curve is bottoming out. What do you want to do? You want to start adding bonds. As it goes up, you're going to get a little backup, and then you get your move down. Now here, same thing, right? Yield curve bottoms. What's your low risk move? You start adding to your bond position, building it up. As it goes down, you want to, or as the yield curve goes up, you start increasing your risk. That this time now, everyone says you're totally wrong. What you're looking at here is possibly the junction of maybe where the sell-off has ended or is almost ended. And what will happen is now the 30s, 20s, 10s, and everything else on the long end is going to go down because the short end hasn't moved. And I didn't put the 2s on here just because it would get too noisy. But what we're likely to see now is the way this curve keeps going up. How does the yield curve go up if rates are going down? Because the 2s are going down. And the 2s are almost at zero. I mean, they're at like 0.1 something, like 1.1 or 1.0 something. I mean, they're low. Yeah, that's implying the 2s go negative. And so that's how you can get the yield curve to continue rising. and a big move down in the long end of the curve. And so you just look at it, all I've done is play, the yield curve by the textbook over 40 years. Isn't this the first time it's kind of really run against me because there's so much speculative shorting? But don't worry, all those positions are going to be wrong. And that's what we're going to get into after we talk about the SLR. Because when you see the yield curve part, you go like, all right, the notion that interest rates are going to go up, 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 and up is not usually what happens. And you've got 40 years of good history of how this thing plays out. So let's talk about the SLR rule, because it's getting a lot of chatter all of a sudden that, hey, this thing's really bond negative and it's coming back in March 31st and banks are going to sell the long end of the curve. Now, many of you watched the same interview that I did with Jeff Snyder and Emil Kalinowski on Eurodollar University. In my opinion, probably one of the most underrated YouTube macro shows there is. I never miss an episode. They're phenomenal. Always learn something from Jeff, and Emil is awesome. And he said in one of the most recent ones, they talked about the SLR rule toward the end of the show. And Jeff mentioned, now you got to keep in mind, Jeff does not play his cards out on the table. So he said this could be the reason that banks are selling the 30-year. He didn't say they were. He didn't say he had any information to prove it. That's just the broad view that everyone is holding right now. And all he did was just kind of say, yeah, maybe there's something to that. So let's look at when this SLR rule came out, what happened when it got suspended, because a lot of people just make opinions without looking at the charts. Now, we're not going to dig into what this thing is because it really doesn't matter that much. What matters is, what effect does it have on the bond market? Because everyone thinks that all of a sudden this coming back means interest rates can only go up. If that's true, then what we should go back in time and find out that when it was enacted, interest rates only went up, right? I mean, that would be logical. And then if you tack on it's because they're doing QE. Perfect. We'll look at when they started QE, because the SLR rule was in effect then. And then that would mean that interest rates could have only gone up, right? I mean, that's what we're going to look for. So here we'll start at the Federal Reserve website. The SLR came out on September 3rd, 2014. So we'll assume that sometime shortly thereafter, the banks adopted this. Now, there was no QE going on at the time. And here's the chart. I left the tooltips on so we can figure out where September is, August, September. So somewhere in here, the banks would have enacted this rule. I'm assuming it wasn't the very next day, but somewhere in here. Now let's take a look. Did interest rates go up? Well, they went down, and then they went back to where they were, and then they went down and back to where they were. Well, they didn't go anywhere. So they went sideways. All right, now let's go and see, when did the Fed suspend this? Because I want to get this number in early here just so you see it, and then we'll go through where they turn back QE. So April 1st, 2020. So we're still not there yet. Now in October of 2018, was it 2018? Let me think. 2019. They turn on the QE. I think it was 18 actually. They turn on QE. Maybe it was 19. It's, like I said, I'm pretty excited about today's show. But anyways, I'm pretty sure it's 18 now that I think about it. And in case you're wondering, no, I don't edit the show. So anyways, they turn on QE and interest rates go down, and they're still running the SLR rule. So the whole idea that the SLR causes rates to go up is evident right here that they went down during QE. Now let's look at April. So March, April. So right in here somewhere where my mouse is, the SLR rule gets suspended and yields go up. Now that's kind of interesting, because perhaps if the SRO rule comes back, well, it means yields are going down. Now let's also clarify a couple other points about this. There's this view that banks are selling 30 years. My question is, do banks even own 30 years? I mean, you got to understand, the banks hold about $1 trillion of Treasury securities. Now, what did we learn recently from that report from the U.S. Treasury is that the banks hold about 75% of their bonds in like 5-year or less maturity. Because what are they doing? They're liability matching. I mean, this is what banks are doing, right? So you put a deposit into the bank that earns interest, and they know about how much time that hangs out there, and they go and match that with an asset. So they're liability matching. So if you think about, okay, how much out of this $1 trillion of treasuries that banks own? Well, we know 75% of them are not 30-year for sure. That's out. So 250 million theoretically could be 30-year. But have you ever gone to the bank and bought like a 30-year CD? Bet you haven't. So the question then I'm going to ask is, why do the banks even have 30 years? Or even if they do, how many could they have? And why they wouldn't have very many, because there's no liabilities that they're matching that are going out that far that would say, hey, we need to have hundreds of millions of these things. And, you think about who needs to own 30-year bonds. Pension funds. Think about who has long time horizons. Institutional money managers, foreign central banks, sovereign wealth funds. Those are the people who buy this stuff. Not insurance companies, not banks, because banks are liability matching. So let's just pretend the banks had 10% of their $1 trillion, right? Let's just pretend. And let's say that you're a bank and you think, oh my God, this SLR rule is so bad, we got to dump our 30-year. Why would you dump them in the overnight market? Why would you do that? Why would you say, hey, let's sell these things during the most illiquid time of the day to drive prices down so we can get absolutely as little money possible for them? You wouldn't do that. In fact, know what you would do with them? Is because the Fed's buying $10.5 billion of 30-year per month via QE, you would take your $10 billion, convert them into reserves, and immediately sell them to the Fed over the next 30 days, because that's the Fed's buying in any 30-day block $10.5 billion of U.S. Treasuries. So is the notion that the banks are piled up on 30 years and unloading them make any sense? Doesn't make any sense to me either. Now, let's talk about what's going on. I want to come back to the yield curve for a second and try to explain what's going on here. So why is this going to split? Why do we see that this can go up and that long rates are going to come down? Well, the way we can look at that is on a chart. And here we've got 2-year Treasury bond prices, and we've got 30-year bond prices. I finally figured out where in my charting program they had the actual 30-year bond instead of using TLT as a proxy. So what you'll notice here, and we've been through this before, but it's worth going again, the 2s are in the green and red, and the 30-year is in purple. So when you see there's a gap between them, one's going to come back to the other. So when 30 years were down and the 2s were rising, 30 years went up. When they got overcooked, they came back down. When they got overcooked, they came back down. And then they followed each other down, back up, down, and the 2s went a little too far. And 2s came back up. 30-year got a little overextended. They both went down together. 2 years are playing catch up to 30, and now they're up here, and you see 30-year went too far, then went down too much, and then a little too far, and should be right up here now, and it's been selling down. So what's happening, and what the yield curve is trying to express, is it's like a rubber band, right? So what's happening is 2 and 10 go together, right? They follow each other along, and when they get out of line and they get stretched, they pop back. So what's happening right now is everybody is stretching this thing as far as they can. Why? Because they think inflation's coming, and they're like, okay, we're going to get this. The 2s are going to crash. What? And then what's going to happen is there's going to be a massive snapback on the 30-year because the 2s aren't budging. We know the banks need so many of these things, and there's so much cash sitting in the system, they're not budging. But yet everyone's stretch. So people say, well, why don't you get out? Why don't you just wait and sell? Because when this turns, I've said it's going to turn really quick. Now let me show you why that is. So let's go back to some of the positioning here. So what would cause this snapback? Well, here's a great view. What if we didn't have a March event like last year, was just a liquidity where the market went down and the Fed came and rescued? What if we have a risk-off move now? I want you to be thinking about this. And instead of everyone thinking that inflation's coming, the risk-off move is deflation's coming. Now, what is that going to do to all this speculative positioning? Well, let's start with a chart from our friend Brent Johnson of Santiago Capital, who sent us this today that showed the speculators are still heavy short. And remember, back in March of last year, they did not cover. They actually increased their short position. So imagine now there's a major risk-off move and deflation becomes the prevalent theme. You're going to see all these shorts come screaming out of here, because that means they're on the wrong side of the fence. And then you tack onto this chart and you look at TLT short interest is now near the highest level in 3 years. As I said, everybody is shorting this. But look at 2020 back in March. No one was really short this. Now they're heavy short in this. Now, if you go back to the charts and say, well, when early 2018, what was going on in early 2018 in the long bond? Well, let's zoom in a little out of this weekly chart. And you'll find that in early 2018, bond prices were relatively low as everyone was shorting them into oblivion, only to be completely wrong about that move. So you've got that going against you. Now, what else might you have? Well, you've got the largest bet on inflation in history. And I know we looked at this chart last week, but look at where people were betting last time in 2020. There wasn't a big inflation bet. Now you imagine this camp. I mean, think of this as a teeter-totter, right? Everybody is on one side of the teeter-totter and super stretched on their positioning. Snap back. Now, so let's get this, right? Let's say we have a risk-off move. Inflation idea is now deflation. How can this thing go up so quick? Well, let's go back to the charts and I'm going to show you something else. So let's look back what happened here. Zoom in. And we'll zoom out just a touch. And then what happened here in March? You'll notice that bond prices rallied going from February all the way up and peaked here in March. This is a big move in the bond market, obviously. It's a huge move. Big gap up overnight, big gap up overnight, and some big price moves during the day. And, so I tell people, look, when this happens again, I don't want to miss out. And say, well, how do you know it's going to happen? Well, we've got to look at volatility, the bond volatility or the move index. This comes from our buddy Travis Kimmel, president of Real Vision. And he sends this over today. And in yellow, you have the move index. This is the VIX of bonds. If you don't know what that is, all volatility indexes do is they just tell you if there's a price change and how big it's going to be. So when volatility goes up, right, it means the movement in price is going to be big. Now, volatility is a knife that cuts both directions. It's not it's not directional sensitive. Now, you can have high volatility and prices going up. You can have high volatility and prices going down. It's normally associated that when volatility rises, that price of equities are going to go down, or in the case of bonds, when you see volatility rising, it's a risk off move and it means price goes up. So let's look at where this is at, and so we can understand what's going on. And then we're going to look at that second wall on the kingdom that I think is not going to get breached at all. So here we see in the move is sitting right around 60. Now, last time it was sitting up here in the 60, it was right before that big move in the bond market going up. So the problem with bond prices right now is volatility has been rising and cutting prices down. But that can flip real quick. And you'll notice when the move goes up, well, guess what's coming next? Equity volatility. This is the VIX in red, and you can see the VIX has been very complacent, but not likely for much longer. So imagine there's a big risk-off event, right? Deflation becomes prevalent. You have everybody that's mega short bond market or piled up in inflation-sensitive assets, and bond volatility starts to go up, and they start flooding into the bond market. What direction do you think bond prices are going to go? Well, I'll tell you. Not only going to go up, but they're going to go gap up, gap up, gap up. They're going to go up fast because it's going to squeeze all these people out. And that's why I tell people, look, positioning, I'm right. The market's moved against me, but it can move very quickly in the other direction. And bond volatility is telling us that. Now, how might I know that we've seen kind of the worst of this? Where's this inner lining of the kingdom that I never told you about? Well, we've looked at it before. But you see these arrows here, these three arrows? These are the 3 rate cuts that Powell did at the end of 2019. And you know what, now I think about it, it was October, was it? Yeah, this is when he restarted QE. It was right in here. It wasn't 18. But nevertheless, if we're going to fix what I got wrong earlier, so you have a peak here. Where's October of 18 or 19 here? Did the SLR rule really cause rates to go up? Well, they ended up going down. So we'll say the jury's still out on that. But this wall here, this is the inner wall. These rate cuts, man, they are hard to get through. Now, the market got through 2 rate cuts up in here. But look at what it took. It took every possible short position, 4 standard deviation short in the long bond futures market. It took 3-year record short on TLT. It's taken everybody selling everything. And even worse, if you look at the COT data, where it is, here it is, you can look at the focus here is on the ultra long bond. So this is as far out as the curve as you can get, is the ultra 30-year. And what's happening? In leverage funds last week increased their short position by 17,000 contracts, forcing dealers to increase their short position by almost 5,300 contracts. So you can see nobody is hardly long except asset managers are massively long this, which also adds to the view on the SLR, that if the banks thought that they were going to lose a lot of money having to sell long bonds, why wouldn't they have covered their longs? Why are they still long? Maybe because they don't own any? So you kind of look at this big picture now and you say, okay, this is probably where it's ending, somewhere right in here. And you look at getting a big move down in treasury yields because the market can easily now go illiquid like it did last March. But on top of it, you could actually get a deflation move. All it's going to take is some news to change the narrative here. And usually when everyone's loaded up on one side of the fence, that's when the news switches. We got the Chicago Fed National Activity Index. Yep, that's next one up. And what it says is trend growth improved last month in January slightly. So that's positive news. The national economy got a little bit better in January. The question is, how long will that last? In terms of inflation that everyone's betting on, the 3-month moving average of the CFNAI is much better. It says in order to have inflation, you've got to have the number over 7.7 for more than 2 years. It is currently at 0.47. So anyone looking for inflation, not going to find it here. Let's see, from our buddy Skywalker, he sends us this TLT chart where TLT is in purple showing when China does a deval, a big one, not like what they did last night, but a serious deval. What happens to bond prices? Well, they tend to go up. Here they went up a little bit before they went down. Here they went up. Let's see, here they went up. Here they were up-ish. And here they were up a lot. Here they were up a lot. And here you can kind of guess what's happening. And last I wanted to look at, don't know if this will be updated in time for the show, and it wasn't. All right. Well, with that, my friends, as you can see, things are getting interesting, and all this move down in bonds can be reversed super quick because now you know that bond volatility is actually looking like it could explode, break through its all-time high there set back in March, and that could send bond prices, you look at TLT, it got over, where did it go, 170? People often ask, where do you think this could go? If you think, imagine there's a big risk-off move now, right? This got up to 180. Was that it? Wow. I thought it was 170. 180. Think about this big risk-off move now, big deflation move. Everyone comes flying out of risk assets. I think you could easily see with all this potential volatility in the bond market, the 30-year, there's your move to 0% on 30-year. What does that take TLT? Like over 200. Could happen. Probably will. And you'll be here, as will I. Until Wednesday, I'm Steve Van Meter. Thanks for watching. The content of this video is provides educational information only. It's not intended to provide investment advice. This material has to be construed as a recognition or solicitation by a selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steve Van Meter, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors, Inc. or Steve Van Meter Financial.